What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is May 29th of 2020. Well, folks, I hope you all are having a fantastic day wherever you are. And in today's video, I not only want to spend some time to go over some comments I made in regards to the recent statement from Goldman Sachs in regards to analyzing Bitcoin as a, well, apparently they don't see it as a financial asset, so we'll be talking a little bit about that as we go throughout the video. And then also talking about the broader cryptocurrency space, some news within the industry, as well as talking a little bit about the current data sets in regards to the real world economy, not only tackling unemployment and just how severe of a situation we're in, but as the Federal Reserve talks about more stimulus, why we're seeing mass amounts of inflation comparative to what the Fed is really stating. We're going to be talking about that all and more as we go through the video right after our quick sponsor. Our sponsor for today's episode is Bitpanda Pro. If you're on the hunt for a proven, trustworthy exchange in Europe to trade your crypto, then I recommend taking a look at Bitpanda. If you're just getting started, many people refer to Bitpanda as the European Coinbase, so it can be a great place to start in getting your first crypto positions. With over 5 years of experience serving the industry by offering easy and secure access to digital currencies, Bitpanda has really earned its reputation. Check out the link down below in the description for more information. Alrighty, everyone, so let's go ahead and take a real quick look across the board for cryptocurrencies. As we can see, for the vast majority of cryptocurrencies, we are in a no trend scenario to the upside or downside. However, for some of the plays that are on the upside right now, there's really two trends that I'm spotting. Not only are we seeing some positivity for some small cap DeFi and CeFi plays, or decentralized finance and centralized finance plays, like Bancor and Nexo, which are doing quite nicely as we have a play up 10%, and also for Bancor up nearly 29%. But also, we're seeing a wide variety of blockchain protocols that are really leading the way again in potential candidates for DeFi, such as Cardano up nearly 12.5%, Ethereum and Ethereum Classic up around 5%, and Tezos up 5% as well. So good to see some positivity for the blockchain protocols that are pushing for smart contracts and dApps, as well as some of the DeFi plays themselves. So I want to go ahead and dive straight into the topic, guys. Goldman Sachs, whether it states as it states here in the title, whether it was intentional or unintentional, happened to spark a war back a few days ago with the cryptocurrency space. And we didn't actually get to talk on this. I did post about it on Twitter, and I want to dive a little bit into my points here. But again, it's always fun to rag on the takes that banks and financial institutions have on Bitcoin because they've been so behind in the industry and keeping up with it. But I digress. I want to be realistic about it, guys. I actually went through and actually tried to digest the points that they made and tried to make a rebuttal to it. And I think for many of the cases, Ivan on Tech, for example, was nice enough to share it. I was appreciative that people liked it. I want to go ahead a little bit further and dive into my points a bit more from what I talked about on Twitter. But the major thing here that I want to explain here is, of course, as you can probably guess, they had a relatively negative take. And I think as some people have brought up themselves, I've met some people, for example, who've worked at companies like Goldman Sachs, the kind of institutional parts of the financial sector. In many cases, they were kind of talking about it on a game theory perspective, that it might be that Goldman Sachs is just trying to cover their rear end for when they start to offer financial services to Bitcoin or other cryptocurrencies, that they can always turn back to this and say, oh, we already talked about the downsides and potential risk with Bitcoin, but you decided to invest in it. That's what a lot of these companies just want to simply do. I have no doubt, as I mentioned at the end of my tweet storm, they're going to start offering financial services in the next 3 years. I'd bet money on it in regards to cryptocurrencies. But again, it's just a bet. Who knows? Might not happen. All right, so let's go ahead and talk about some of these key points here that they mentioned, and we'll actually go through and actually digesting some of these. So cryptocurrencies, including Bitcoin, are not an asset class. First off, very bold statement to make, and that's where I'll start off on my arguments. They do not generate cash flow like bonds. They do not generate any earnings through exposure to global economic growth. They do not provide consistent diversification benefits given their unstable correlations. Do not dampen volatility given historical volatility of 76%. On March 12th, 2020, the price of Bitcoin fell 37% in one day, referring back to the sell-off that we had recently. Does not show evidence of hedging against inflation. We believe that a security, Bitcoin's not a security. Wait, hold on. This is like the big thing here that was like the moment I knew that this research team surely doesn't realize that Bitcoin not only is an asset class, but it's certainly not a security. It was not issued in some kind of public offering. Anyways, we believe that a security whose appreciation is primarily dependent on whether someone else is willing to pay a higher price for it is not a suitable investment for our clients. We also believe that while hedge funds may find trading cryptocurrencies appealing because of their high volatility, that allure does not constitute a viable investment rationale. So I probably don't even have to say anything, guys. I know you probably are having like an argument with your screen right now, shouting at me. I wish I could hear you because I'd probably agree with you. But let's just go ahead and dive into this. Let's have a little bit of a rant and rave here, because I surely went off on Twitter the other day, and I tried to be as rational as I could about it, but I couldn't help but get a little bit flustered. And I want to build on some points, because some people, again, will try to take it out of context. Some people will say, well, what about this and that? And I'll clarify on all of those points, okay? So here's why they're wrong. First, on the topic of cryptocurrencies not being a new asset class, they are most certainly a new asset class. One of the biggest issues that I've seen companies, like Goldman Sachs, and I guess there's countless others who have probably made the same correlation. I've heard Peter Schiff talk about this, about cryptocurrencies, how there's thousands of cryptocurrencies out there in the market. And with that, we have an endless amount of potential crypto wealth that Bitcoin itself therefore becomes worthless because it can be forked into oblivion, that you can have other cryptocurrencies that could compete with Bitcoin, that could have much larger supplies or not a fixed monetary policy. This is completely irrational, because when we talk about Bitcoin serving as a hedge or as a store of value, we're not talking about the countless forks for Bitcoin. We're not talking about Ethereum, Litecoin, and all these other cryptocurrencies. There might be a potential for them to be a secondary hedge, similar to how we have gold and silver. But when we talk about Bitcoin as an asset, you cannot just simply fork Bitcoin into oblivion and dilute the base core supply of Bitcoin. That hasn't happened yet, and it never will happen. That it is programmed directly into the protocol that there's going to be a finite supply of cryptocurrencies in the Bitcoin network. And this is a huge selling point. The supply is fixed. There is no other asset in the world that can guarantee this. Central bank currencies do not guarantee this. The amount of treasuries that get issued do not guarantee this. The amount of stocks a company issues is not guaranteed to a limited supply. They can continue to dilute the supply. Big company that I'm a fan of, Tesla, does this all the time, and investors in many cases tolerate it. But in the case of Bitcoin, you don't have to tolerate it. It's already fixed. Along with this, you have gold and silver, commodities that take work to produce, but they don't have finite supplies. They have limited supplies. They usually have about an inflation rate of about 1 to 2% every year, which make them great stores of value for the most part. But something that's absolutely finite and is going to get to a point where it has a better stock to flow than gold and silver gives it a very unique selling point for a potential store of value and hedge. So again, completely wrong on this. Completely wrong on it not being an asset class. It's completely separate from anything we've ever seen before. Second off, they claim that the only reason people buy Bitcoin is because they expect to sell it to another person at a higher price. The same exact thing you expect every time you buy a stock, bond, or property. Now, again, this is something that I think people always misconflate. I've heard people like Peter Schiff constantly say, oh, Bitcoin's a bubble. You're just looking to sell it to a person for a higher price. Yeah, okay. That's exactly what you're doing with every other asset. Now, I've heard an argument, as some people probably replied to the tweet on this. A lot of people brought up the point where it's like, well, Nick, a stock can pay a dividend. Along with this as well, Treasury pays a yield in this case. What's your argument to that? And the whole point is that, man, take a look at the broader stock market. You think people are owning Amazon for a dividend? Or they're holding treasuries, as I talked about in the same tweet just a couple of tweets down, about how treasury yields as well as government bonds across the world are going negative? You think that's an incentive to hold the asset? And here's the thing too, even if you're getting paid a dividend, there's a ton of dividend stocks over the last few years now that we've had the pullback that we've had post-COVID-19, that considering the dividends paid out, your base principal has negated any return you've gotten for your dividends. That's a really petty argument to try to make that case where dividends themselves are the sole incentive driver for people to own a stock. Yes, if a company starts to pay a dividend, that can be an incentive for people to hold a stock, or maybe for the price to go up, and vice versa. If they cut the dividend, sure. But it's not the sole reason people buy companies. People buy it for the base principal going up, and a dividend is a plus, right? If your base principal price doesn't hold from where you bought it, you're going to be selling it probably at a lower price and negating any benefit you got from your dividends that you waited for. So now you've not only lost money in the general scheme of things, but you've been holding this asset for a prolonged period of time, taking all this risk and inevitably losing in the long term. So again, it's petty arguments like that that continuously come up. And again, I bet you'll hear from Goldman Sachs types, but that's the problem. The vast majority of stocks don't pay a dividend. And as we see the bond market continuing to go negative, as we'll talk about later, again, the argument there just doesn't exist. To them, Bitcoin's volatility dismantles its ability to be an asset. Goldman Sachs, allow me to introduce you to the multi-trillion-dollar commodity oil, which turned negative just a couple of weeks ago. Oh, but that's a market, right? And this is the kind of point that I always bring up, right? We're living through extremely turbulent times, guys. And any time that, for example, a company like Goldman Sachs that's supposedly so respected comes out and makes such a faulty statement when a well-respected commodity class that's been traded in futures markets for decades upon decades is now seeing negative prices, and they're completely tolerating that, but they're not able to tolerate the idea of a non-correlated hedging asset that's completely separate from central bank monetary policy. I just can't believe it. And the thing is that what they completely negate here as well about the volatility, it's not just something that's interesting to traders, it's interesting to a lot of investors, because the reason it's volatile is because it's about a $250 to $300 billion market over the last month or so. It's a very small market in the grand scheme of things. It sounds like a lot. But in the end, when you're talking about government bonds and treasuries, you're talking about nearly $100 trillion market. When you're talking about equity markets globally, you're talking about another near $80 to $100 trillion. So Bitcoin and cryptocurrencies are a very, very small blip on the map when it comes to the overall wealth of the world. And that's why it's so volatile. But generally speaking, if you actually look at most historical measures of volatility, outside of a few anomalies like what we saw back in March, volatility has been declining, historically like we've seen with gold. And that's what happens with an emerging store of value. Now, going on to the fourth point here, they cite that Bitcoin doesn't provide a yield like a bond. Gold and many other assets don't provide a yield. This is my key point here. They probably see gold and silver as assets. Why is it that they don't see Bitcoin in this case as an asset simply because it doesn't provide a yield? Or were they referring to those lucrative negative yields, the ones in Europe that penalize you for holding the bond? So again, you could be holding German bonds. There's all kinds of different types of government bonds across the world right now that are paying a negative interest rate. And you are mandated by the federal government and by many of these financial institutions and money managers. They are mandated to hold some allocation of these bonds. It's a forced mandated government Ponzi scheme. If you really think about it, being forced to dilute capital in this case, again, it's so mind-numbing to see this and just to have to read Goldman Sachs make these kind of arguments. But you get my point here, right? An asset that doesn't pay yield isn't bad, right? Because the underlying reason people are buying it, as we talked about with stocks and like with most assets, is to see the appreciation of the base price, to hedge against inflation, to hedge against fear, to hedge against the downturn in other markets, to see capital allocation shifting between markets. That's what Bitcoin is all about. And I'm very realistic about talking about that. I don't think Bitcoin's just going to 100K or a million simply because it's just going there. We need that liquidity to flow out of markets out of fear of other assets. And that's exactly the kind of environment we're in right now. Or for central banks to continue printing liquidity to excessive levels. It will naturally flow into assets like Bitcoin. And it's why I stand vehemently behind my point of 100K Bitcoin by sometime in late 2022 to 2023. Hopefully for November or December. That's our target, adding a year from the previous cycle in the sense of the length of the cycle. Hopefully that makes sense. I can talk about that a little bit more in another video. I think we've talked about it before. Anyways, this is another point here. Supposedly they believe Bitcoin hasn't hedged against inflation. Now, here's the really important point to get across, guys. Nothing in the market, not even gold and silver, is a direct correlated inflation hedge in this case. Okay, now let me explain that. For example, over the last decade, central banks have inflated the base currency supply since back in 2011 when gold peaked. Was gold going up for the last 6-7 years beforehand, before we started to kick off the cycle in late 2018? No, it wasn't. You know what was going up? Equities were going up, right? So this important point here about, something directly correlated to inflation. Bitcoin, yeah, maybe it didn't move up exactly when the Fed announced certain rounds of QE. Maybe it didn't move up exactly in tangent with other assets that performed quite nicely. The thing is, though, at the end of the day, Bitcoin performed the best in a decade of central bank monetary policy. They have performed excessively well. If we have any data points to look at for Bitcoin, we should take the benefit of the doubt that even if it's a 10 or 20% chance that we are going to see right here, right now, Bitcoin lead the way in an environment where central banks are entering to rapid levels of monetary policy that we haven't seen before. It makes no sense whatsoever here in regards to cryptocurrencies to be negative on the idea that it's going to be able to hedge in an environment where central banks are printing crazily, and along with that as well, where they're entering into environments where they're normalizing negative interest rates on savings accounts, negative yields on treasuries and government bonds. An asset like Bitcoin that can't be printed into oblivion, and along with that as well, doesn't pay out a negative interest rate, it doesn't penalize you in this case or charge you for holding the asset, is a huge selling point in this kind of environment. So again, the whole thing here is that in an environment where central banks are printing like crazy, all assets are a hedge against inflation. Stocks are a hedge against inflation. Bonds, in this case as well, possibly can be for some time. And then last, you really have gold and silver as well as Bitcoin in this case. Right? Because when the Fed's buying up things, yeah, the base principle of the bonds are going to go up. Right? And that's why traders are buying them. It's not going to last for long, though. The real hedges that exist are really going to be gold, silver, and Bitcoin. No ties to any national government, no ties to any specific economy, non-correlated assets. That's what people are going to be looking for. And the last point here before my closing point, and to top it all off, they feel that though traders are interested in buying and selling in the short term, it negates it as a long-term investment. Kind of like how people rampantly traded tech companies that inevitably came to dominate equity markets. This would be like saying that Amazon or Google or Microsoft or, oh God, I mean, the countless other tech companies out there that were traded during the dot-com bubble speculatively, that many didn't have, a net income, that were still generating maybe, measly revenues and really hadn't formulated as a company, but had innovative tech. That all those traders, those Nimrods and stuff who were basically trading those companies, that basically made those companies unjustifiable. They would never reach those valuations again, and it was all a speculative bubble. Of course, it was a speculative bubble to a degree, but there would be no chance that those assets come back and become valuable. Well, the naysayers on all those tech companies got proven wrong in the long term. Those companies dominate the NASDAQ. The QQQ ETF that gives you a broad exposure to the NASDAQ has an overabundance of exposure to the major tech companies because they have started to become multi-trillion-dollar companies. All these arguments are extremely petty. And in conclusion, I made the bet that I'll put money on the sideline. And I'm really kind of doing that by having my money in crypto markets. But I would bet serious money that they're going to be offering cryptocurrency services in the next 3 years. And you know why? Because I believe, and justifiably, that we're going to be reaching Bitcoin at around 100K by 2022. And the moment, not even by 100K, but the moment we get back up to 20,000, maybe by the end of this year, beginning of 2021, who knows, might be even longer. No matter when it happens, when we get above $20,000, that is going to be the inflection point where all of these companies are going to feel a sense of FOMO, that they have either not offered sound services to their clients, and even if they're not feeling the FOMO, their clients are going to be dialing up on the phone and saying, look, I don't care how you get me into this. I want 5 to 10% exposure to Bitcoin, and I want it now. Get it? Like that's simply going to be what it's like. There are going to be people like that, and if a bank doesn't provide that service, they will turn to other service providers. I hate to get fired up about it, guys. It's the ignorance. What really irritates me, I don't really mind it if it means banks starting to slowly lose their exposure in the world of finance because they're archaic and they haven't been serving their customers for a very long time. But I want to say it irks me more than anything to see the ignorance of dying and aging companies. But you know what? That's the way of the world. It's understandable why it happens. And all in all, if we take a look here at Bitcoin, guys, I can tell you, if we look at the chart, things are looking great. From the current price action that we've had over the last few months, the SMS indicator, the wedge that we've been building up, coming up here, possibly building support on it like we did gold and building up, I think we could see something happen in late 2020 to early 2021 where we get above those highs and we start to show the world what Bitcoin truly is made up of. Anyways, going on here, we've got a few other things to talk about. First off, one interesting thing here, the number of Bitcoin exchanges in regards to holdings at the moment, the total number of holdings for Bitcoin exchanges across the board is actually seeing an 18-month low. We've been noticing that there's a big spike in transaction fees on the Bitcoin and Ethereum network, and I think this has a lot of the telltale sign as to why this is happening. Fees have been relatively cheap for the last few months, but with a dramatic outflow ever since March here where we had the dramatic sell-off where people have probably been moving funds off of margin trading platforms, moving back into their wallets or better exchanges where they're just simply holding and stop trading. This is leading a lot of demand for fees on both networks. So it's very interesting to see this. I'm happy to see people moving their money off of exchanges because quite frankly, guys, especially on margin trading platforms, you're likely going to get ruined on it. I do not advise whatsoever. Again, I can't be your financial advisor, sadly. But at the end of the day, you should stick clear from any excessive levels of margin unless you know how to use margin as a tool and that you can properly trade it in your jurisdiction. I know a lot of people have been trading it in jurisdictions where they're not supposed to be trading it. And along with that as well, it's important to note that at the end of the day, long-term holders perform better. Okay, so if you want to play the risk and the odds, that's fine, guys. If you want to treat it like a casino and go play with margin, it's not my business to tell you what you can and can't do. But most people are going to lose out. Now, I want to talk about the broader picture here. And the reason why I think the longer-term perspective is so important. The Fed is setting up here to start its new economic policy, to start the new quantitative easing program that they're going to be engaging in, that's going to be injecting billions of dollars into mid-sized businesses across the country. So this Goldman Sachs expert wrote a piece here, generally kind of reference to what he thought was going to happen. So he first expects that the Fed is going to establish a more consistent quantitative easing program. So basically, they're on pace to about $80 billion to $120 billion in Treasury security purchases a month consistently, and $25 to $35 billion in mortgage-backed securities. So again, continuing the same program that they had. So this is not going to just be a capital relief program for small businesses. This is going to be a program, again, to continue stimulating asset markets. As you've probably seen, as every time we get a pullback in the market, people get thirsty. Like, we want more stimulus. We want the Fed to keep bailing us out, giving us more capital. Well, what they're doing is going to be providing that capital relief in regards to the markets. So again, this is something that they've been doing for a very long period of time. The Intercept put a really nice article here talking about this. As we've been going through the coronavirus, it's been the biggest excuse here for the Fed to constantly stimulate financial markets, where they've done little to nothing, as they supposedly can't do paycheck protection program equivalents to the Fed for everyday people. Now, they can do it for hedge funds, though. That's the whole narrative. And what have we got here after the Fed has injected billions of dollars? We have unemployment at levels that we've yet to see throughout U.S. history since as far back as the Great Depression. More than 14 million Americans right now unemployed. Unemployment claims as well. Continuing jobless claims at 25 million. Actually, I guess it would be about 25 million in this case for continuing. I mean, this is just... These are real lives that the Fed has left behind. And it gets to me on a really personal note. And again, I really hope, we're seeing a lot of anger right now in this country. And I think it's justifiable to a degree. It really is. Because when I think a lot of these players and stuff think that some of them think they're serving in the better interest of people and they're just living in their own little bubble. And along with that as well, some people think that they're getting away with murder. Don't think that people aren't smart enough to start picking this up. I know you guys are smart enough to start seeing this. You've been seeing it probably for a very long period of time. And it's really disgusting to see how normalized this is. Here's the interesting thing. The Fed is coming out right now and saying that with all this money printing, that the annual inflation rate for 2020 as a whole, where we've ramped up the base monetary supply to a large degree, is sitting at 0.3%. Now, if you maybe go look at consumer goods, maybe the inflation rate has stayed around that price range. I can tell you in some cases it has and it hasn't, depends on the industry. But I will tell you that this is not the real inflation rate. Because the consumer price index that the Fed uses here to justify the measurement of inflation is completely off par for what real world inflation looks like, because buying goods and services is not the only thing we pay for in our lives. We also pay for our living expenses, our rent, our home, our mortgage in this case. We have so many other things that the Fed does not consider. And if you take a look at the Chapwood Index, this is a really interesting tool you guys should bookmark. Keeping your bookmarks to turn to in the future. This shows you on an annual basis the real rate of inflation. How every basically 10 years, if you're not keeping up with doubling your income, you're losing purchasing power. Things are getting more expensive. Have you been feeling that? Have you been feeling like it's hard to get by? It's because the real inflation rate is present. The asset markets that we build up impact everyday people. They don't help everyday people because the bottom half of this country owns less than half a percentage of assets, but we all got to live in a home. We all got to have some place to stay. We all got to rent somewhere or take a mortgage in this case to buy a property. And the Chapman Index keeps those things in mind. It keeps in the rising expenditures of things like health insurance, but it also keeps in things like rent, your electricity bill, all these things that, again, a lot of them are random items that wouldn't be considered for the consumer price index. So you're getting a wide range of items here. And we're seeing this consistent rise here that the consumer price index, the CPI, doesn't even account for. This is the reality and why it's so important that if we're going to be entering into a stimulus program, injecting cash into the economy to get things going, that central banks need to directly help everyday Americans. A $1,200 paycheck isn't going to do it when you're printing trillions of dollars for hedge funds and money managers. It does a great thing for the stock market, but it doesn't do anything for the bottom of America. Anyways, well, guys, I would say above all, you know what assets are working well during this time period. You got to make the decision for yourself about where you want to be allocated. I bet many of you have already made that decision. All in all, I want to thank you all for listening to today's video. If you liked my ranting and raving, I know I was a little bit fired up today. I'm usually a very calm and selective kind of individual, but today I felt a little bit fired up because it's always fun to give a rant and rave and call out the BS from the traditional financial sector. Let's call it for what it is. Anyways, I love you guys. Thank you all, as always, for watching. It's always good to have you guys here. You're a family to me. And if you like the video, again, consider liking. And if you're new to the channel, consider subscribing and hitting the bell icon. But all in all, I'll see you all in the next video. Stay tuned.